Let's talk about adjusting zero DTE trades or day trades. So this morning we had on this position at the zero DTE time frame, and we had to buy it back and then move it to 3 days expiration or on Monday. And then we had to move it again. We had to do what we call a rollaway because that's how strong the market has been today. And so, but if you had something on currently, for example purposes, let's say you were at this 39 42, this 39 delta, the 42.90, the 43.10, and you had to buy this back. This is going to cost you right now cheaper than, or basically what it cost us earlier this morning. We had two contracts, so something like this, right? I just say you had one contract here now, and it cost you, let's say, 265 to buy it back, and let's say your put side is basically worthless. Okay, so let's say you need 265. So what you would do is, if you were going to buy this back, you would roll it out and you would look to something out further. In this example, because we have something at the 3 days, let's put it at the 4 days, and let's say we're going to roll this out. So we would sell the, let's just say, this 19 delta, keep it 20 points wide. That's already giving us the 255 at that point, right, for that one contract. Then on this put side, this would be the non-tested side, so we'll add something there. So we're getting $4. So at this point, if you were able to wait that long with the zero DT trade, then that would really work for you. That you can obviously move it away from at the money more here and still get the 265 that we were talking about, right? So that increases your odds the more you move away from at the money, because this is the at the money line here. But we wasn't in that situation. Let's say that we actually, instead of 265, we needed 400, right? So or we needed $400. So if we go back over here and we look at this, that's now 370. So 400, we would have still had to be, a little higher to be able to get that. So let's say we didn't want to go any higher than the 20 there, and so here at 15. So this would give us the four. If we needed 400, this would give us 420, 430 down here. This is how you would move the trade to roll it out, to give yourself a little bit more wiggle room, because on the zero DTE right now, based on the example we gave, you were at the money. Right? So giving yourself a little bit of room, for the market can go up on on Monday, or in this case Tuesday. It can go up the next couple of days and still be able to adjust it. Maybe you have to adjust this on Monday if you were rolling this out 4 days. This is going up on an option chain, so you have a little bit more room. Going down, this is going down on an option chain, so you have a little bit more room there. And so if we break this down on what we just talked about, right? What we actually had to do, this is the trade here, and we adjusted it, and you can see that we have a little room on the put side. I mean, whatever you did on the put side worked today. I mean, you didn't have any problems to that put side all single day. But the call side has been, whatever you had on the call side today, has been challenged. And even if you started at a 5 delta today, you would have been challenged, because this market has moved up so much more than the expected move. The expected move was at best about 27, something like that, yesterday at the close. We are at 67, 68 points up at this point, and that's on top of being up 40 points yesterday. So really, really strong up move. It was definitely unexpected.
Please subscribe to our channel. Happy trading.
But when you're doing zero DTE trades, or any type of short-term trade, I'm talking about zero DTE at this point, you have to know how to adjust if you're not doing the 3 times or the 2 times the stop loss. Obviously, in this account, we wasn't doing the 3 times the stop loss, so we rolled it out, and in this example, we added an additional contract to be able to roll out, but it's still not benefiting us significantly at this point, because we wouldn't put this trade on. We have a good chance, I think, to win on Monday, but if we were putting this trade on right now, we would have a 62% chance of winning at expiration on Monday. That still means the odds are on our side to be able to win something on Monday if we were putting this trade on right this second. But it's not ideal the way we want to be. Normally, if we're initiating the trade, we're probably initiating no higher than the 10 delta if we're doing these short-term trades, these zero DT type of trades. But what I expect to happen on Monday, which I can completely be wrong, like I was yesterday when I said if we were going to make a big move, it would be to the downside. Right after I said that, maybe 5 minutes, 10 minutes, something, as soon as that, the markets just started going up, and it hasn't stopped yet. Literally, it hasn't stopped yet. But I think we're not going to go down a lot. I'm always going to have an assumption, and I'm going to play my trades based on those assumptions, right? And if I'm wrong, I still want to be right. So in this case, I think on Monday we're going to stay in a tight range. We're going to stay in a tight range. We're not going to go up a lot, because we've already went up a lot. The market's going to pause. That's going to be the fraudulent down day of just a small pause. Well, if we stay inside of this range on Monday, let's say this what TastyTrade is saying is the expected move based on this ruler here that I'm outlining, then we should be able to win on this trade, right? We should be able to win the trade. But if we have an issue, then we're going to have to roll out the trade again to extend duration. But as we were talking about today on the trading floor, we don't want to give back any premium. We don't want to give back any premium from the policy that we wrote. So we're going to do all we can not to give back this premium. And so if we go and look at what's happened so far today with this SPX trade, we've had to adjust it. We've had to adjust it quite a bit, but we still was able to do everything for credit, right? So if you take that $80 and you subtract the commissions of $16 and you subtract the fees of, let's just say 22, well, we still did all of this for a net credit of $42. So the policy has changed, right? We had an agreement with the buyer of the policy, and we decided we were going to change the policy, some modify it, but we modified it in our benefit to this point because we did it for a credit. Right? If you think of if you use the kind of concept, the insurance concept, right? The insurance analogy that we like to use so often. And so when you're doing the zero DT trades, you need to know how to adjust. Right? If you're not going to use, once again, if you're not going to use the 2 times or 3 times stop limit, which we use most of the time that we talk about in the statistical day trading course that Dr. Meadows has made for us. If you're interested in that course, you can obviously go to our Dorian Way school and be able to get that course. As a member, you can get that course for a discount, at $50 off the $250 price. But anyway, this is what you want to learn. He talks about adjusting on there. He talks about using the three times stop. I'm throwing in how you can roll this out, right? So we might have to roll this out on Monday to 7 days out. We might have to roll it to 14 days. But whichever way we roll it next time, we're going to try to give ourselves some wiggle room, some breather, some air, so that we can be able to win on this if things slow down. I'm more comfortable with having pressure to the call side because eventually things are going to slow down enough for me to be able to win. I'm less comfortable with things falling a lot to the downside because when the market is falling a lot, the volatility is actually increasing. As you can see today and yesterday, the volatility has decreased, and it's decreased significantly. We haven't seen a 14 handle in the cash VIX, in any VIX, since 2021, right? And this is what we lived in for about a decade. Around 12 to 15 was the what we lived in. It felt like for a decade. It was common to see the VIX this low. Historically, the VIX is 15 to 17. We're obviously a little below the historical average, and we haven't seen these lows from quite some time. So it's no fear out there